Worry more about disinflation over the long term, not inflation, says Viktor Shvets. He is global strategist at Macquarie Bank and also author of Great Rupture. Viktor, welcome to Kitco.
Thank you very much for having me, Michael.
Viktor, you said that people who worry about inflation overlook that the economy is just different today than the economy of the past.
Yes, indeed. I think people are looking at today's environment as if we live in industrial age. Everybody looks back to 1960s to 1970s, but we don't live in 1960s and 70s. There are fundamental differences. Technological environment is very different. Demographic environment very different. Labor market and capital markets do not function the same way. Just to give you an example, if you go back through time, labor was a primary productivity driver. Today, that increasingly is no longer so. If you go back in the past, labor usually was unionized. Even in the United States, 1/3 of the labor force was unionized. Today, in almost every country, unionization level is extremely, extremely low. Back in the olden days, people were employed in factories. Today, it's mostly service orientation or the gig economies where people are really stretched considerably. Now, if you think of corporates, again, 50s, 60s, 70s was a time of inventiveness, not innovation. Everything we have today was invented in 40s, 50s, 60s, and 70s. But the products only came through over the last 20 or 30 years. So if you were corporate in 1960s, you had a brand, you had a product, you had a distribution system. Today, corporates by and large lose their pricing power. Occasionally they gain it, but then they lose it very quickly. They lose control of their products, they lose control over their distribution. So once again, that functions differently. Capital also very, very different. Back in the olden days, it was all about roads and bridges and factories and machinery. Today, 60% of private sector GDP in the US is intangibles. In Europe, it's between sort of 25 to 50%. Intangibles don't function the same way. They don't have the same capacity constraints. They can give you spillover effects and synergistic benefits quite easily. So all of that is different. You also have very different demographics compared to 60s and 70s. And at the same time, what you have is leverage and financialization, the legacy of the last 3 to 4 decades. We're more than 6 times more leveraged than what we used to be in 1960s. So when people say, hey, you know what, we'll run out of capacity constraints, how do we know what are capacity constraints in this world? And that's a reason why Phillips curve stopped working for at least the last several decades. That's part of the reason we can't really compute what is inflationary neutral unemployment rate. That's why there is no relationship between unemployment and inflation. So to me, I'm not arguing that there is no constraints. Clearly, there are, and we will find at some point. But what I'm arguing, constraints are melting away in front of us. Every day, those constraints getting further and further and further away from us, which means we have to run much, much harder to catch up. Now, that implies that disinflation is still the predominant trend, even though there could be spikes of inflation in between.
Now, you did mention disinflation, and we do have Biden's infrastructure package that is really trying to land right now. You said something interesting in a previous interview. For example, you said that oil could be inflationary, whereas lithium, it could be disinflationary.
Yeah, well, essentially, what technology does is reduces marginal cost of everything to zero. So information almost at a 0 point now, trading cost almost at a 0 point now, publication almost, whether it's book or anything else, almost at a 0 point now. Over the next 10 to 20 years, we will be disintermediating physical matter rather than information digits. In other words, it's all about new energy platforms, new transportation platforms. It's about robotics, automation. It's about infotech, biotech. It's about green energy. So it's going to be a more capital intensive era than the last 20 years. But it's not going to go into bridges and roads and factories and machinery. It primarily will go into digital age, bringing that digital age forward, crystallizing it. And what digital age does is reduces prices. And so the result is lithium price can go up, but battery prices continue to fall. Whereas oil and much more traditional industrial age commodities tend to be inflationary. They tend to have supply impact on the inflation rate as you go forward. So the difference, industrial age has capacity limitations. Industrial age has limited scalability. The digital age have much weaker capacity constraints and almost no limitation how much you can push it. And therefore, over time, technology reduces marginal cost. So any commodity that you use, whether it's semiconductors, if you regard semiconductors as commodities the way I do, whether it's lithium, whether it's copper, whether it's cobalt or nickel or rare earths, they're contributing to technology and digital age, which means they're contributing to disinflation. It's something that oil or coal, for example, doesn't do.
You mentioned leveraging. Do we need to be concerned about government spending?
Yes and no, insofar as it's all about how we look at the government debt. So the question I usually ask people, globally, we currently have over $400 trillion of pieces of paper. Now, if you add derivative contracts and if you add off balance sheet financing, we really could be looking as much as $800 trillion. So that's theoretically 5, 10 times GDP. Do you really think any of this will ever get paid off? Well, the answer is no. And so what we're engineering is a control default. And that control default can take a couple of forms. Traditionally, it was about inflation. In other words, you erode the real value of debt as you go forward. But now we have different means. Certainly, Japan invented it about 20 years ago, which was known as a QE. The rest of the world joined in around 2008. So we now have central banks and treasury functions that can actually eliminate most of that debt as you go forward. So when people say, oh my God, we're spending so much money, interest rates will go through the roof, I usually say to those people, have you heard of Bank of Japan? Have you heard of Federal Reserve? If you think of Japan, 20 years ago, people were afraid that if inflation takes off and interest rates adjust, Japan will go bankrupt and will be spending 80% of its budget just servicing debt. You know how much Japan is spending now on the debt? 4% of the budget. 4, not 40, not 80, 4. And so as we progress, there are other avenues of dealing with debt, which are much more effective than just inflation. So people who say we must inflate are very much living again in industrial age societies and not recognizing extent to which we have changed. Now, I'm the first one to accept, if we go back in time, if we could, back to 1980s, we could make decision not to financialize. Why did we do that? Why have we decided as a society globally that we need to have debt? Why have we reached the stage that we need $4 or $5 of debt and financialization for every dollar of GDP? When 50s and 60s and even 70s, they only needed one. So what made us to make that decision? And if we go back in time and say, you know what, let's not have it. And if we decide not have it, the world today will be much smaller. Most people will be much poorer. Emerging markets would never have emerged. And neither would have China, by the way. And so we're a product of what we have decided 4 decades ago. So there is no point of going back and saying we need to reset, because reset implies that your 401k are worth nothing. It implies that the house you're living in, for which you might have paid $100, is only worth $50. So that type of reset is completely unacceptable, either from a social perspective or from a political perspective. So some form of trying to ignite a little bit of inflation using central banks and treasury functions to manage the sort of default over very long periods of time, to eliminate debt through perpetuals and QEs, that is our future, not resetting.
China's economy has come to the fore. It's really the story of this century. Despite the impressive leap, what could hamper China's economy the way that the country is currently organized politically?
Yeah, it's a great question, Michael, because Most people look at China and say either it's a dramatic illustration what the state can do, and what a more controlled sort of environment can achieve, or they argue China is just a paper tiger. And so there are those two extreme views right now. Now, the reason you have two extreme views is that China developed its economy quite distinctly different. Anybody who expected China to become a liberal free market economy were proven decisively wrong. And so the question going forward, given that China already caught up with industrial age, given that China had already gone beyond the industrial age, can you invent whilst you're not free? One of the lessons from my book was to say, look, you know what? The lesson of the last 500 years was that if you don't have a freedom of expression, if you don't have a freedom of exchanging views with other people, if you don't have a freedom of exploration, then you are destined to oblivion. That's what happened to Imperial China. That's what happened to Imperial Russia. And that's why England had its Industrial Revolution. However, we're changing. As I said, the government doesn't function the same way. The capital doesn't function the same way. Labor market doesn't function the same way. At the same time, increasingly, we have a much stronger computational power. We have artificial intelligence gradually on the horizon. You have declining demand for postdocs, people who finish their PhDs and are getting ready to move beyond that. So the question becomes, in that environment where humans are becoming less important in either innovation or inventiveness, do you need to be free? Or if you're not free, does it mean that you're destined to oblivion? And so China is facing it right now, and China is trying to prove that degree of freedom that people exercise does not need to be as extensive as what West believes. And that will not preclude you from being inventive, and that will not preclude you from innovating, and that will not preclude you from accumulating wealth. And in many ways, the West kind of agrees as well. Because if you think of the role of the government these days, certainly over the last several decades, the government's been involved far more in suppressing and managing business cycles, far more in suppressing and managing capital market cycles than they've traditionally been. So one of the questions I ask in the book, instead of China imitating us, are we starting to imitate China? And can we find the right equilibrium? In other words, the equilibrium which still preserves the rights that we all enjoy, and at the same time provides us with a management of economy and management of our future that is in line with what people want. And the interesting thing, Michael, is it changes in generations, because there is no question that Millennium and Z generation have views much closer to their grandparents than to their parents. In other words, a younger generation want to have environment which is less entrepreneurial and more bureaucratic, less free, but much more fair. They don't subscribe to the idea of growth at any cost. They are much more communitarian. They're much more sharing and far more society oriental or climate oriental than the previous generations were. And so what you have a generational impact driving it to greater state control. You have technology driving you to greater state control. And I don't think the West will imitate China completely, but all I'm saying, some of the differences between the way China runs its economy and the West runs its economy are actually narrowing rather than getting wider.
In another interview, you said that if there is a financial crisis, cryptocurrencies could be the culprits.
Yes, usually central banks and investors look at the past. That's a very traditional human way of doing it. Because if we didn't look at the past, if we didn't draw the patterns, we probably would never have survived the jungle of Africa. So everybody loves looking at the patterns. And so everybody looking back and saying, what caused our problems? Was it debt? Was it the banking system? Was it the mortgage markets? What actually caused the prior problems? And central banks are not immune from that. They are fighting always yesterday's battles. They're not really fighting tomorrow battles until tomorrow arrives. And so the question is, what is tomorrow? And to me, tomorrow is not about mortgages. It's not about real estate. It's not about the banks, which were quite recapitalized and now in a much better shape than what they used to be. It's not even about NASDAQ. NASDAQ today is populated by highly profitable companies, which has a lot of cash flow, a lot of return on equity or assets. That's why the multiple today on NASDAQ is only 30 times, not 100 times, the way it used to be back in 2000. But there is an underbelly of NASDAQ, which is derating now. And there is a new asset classes, things like digital assets. That could be your cryptocurrencies. That could be part of your blockchain transactions. That's NFT. That's special purpose vehicles or SPACs. Um, and it's really how they relate to each other in their size. First of all, they've grown dramatically. Until latest correction, they were worth at least $4 trillion. And the way I usually say, if you lost $1 billion, it's just a bad day in the office. But if you lost $1 trillion, that really is systemic. So first of all, they've grown a lot. Secondly, they're becoming very interconnected. In other words, if you go back to '05, '06, '07, it wasn't so much that the mortgages were bad. It's the way you combined them, the way you packaged them, and the way you leveraged them that created global financial crisis. And that's exactly what is happening right now. So if you invest in Cassie Wood ARK ETF, for example, she invests into Tesla and she invests in Bitcoin. Then Tesla was investing in Bitcoin. Then SPACs are now buying triple C debt and also investing in the new ventures, new startups, and the likes of Bitcoin or other cryptocurrencies. So increasingly, it becomes very incestuous, and you're doubling exposure and tripling exposure without richly recognizing that. Some of the exchanges now allow you 3, 4 times leverage, some even 100 times leverage. So you can see how, if those assets continue to proliferate, if the valuations continue to climb simply because people have nothing better to do with their money as they go forward, it's really the interconnection between private capital, between speculators, the special purpose vehicles and SPACs, between digital assets, NFT assets, somewhere in that intersection, there is going to be a blowout. And because it's going to be so large at some point in time, it will become systemic. And the Federal Reserve or other central banks will not be aware of it, in my view, until it actually happens. So to me, that area will be the most likely area where the markets could blow up. In other words, digital assets and everything associated with those digital assets.
How does gold look to you vis-a-vis crypto?
Well, the way I look at it, cryptocurrencies are not currency in terms of medium of exchange. It is unlikely they will become mediums of exchange. Cryptocurrencies are unclear how much they will provide you, either with independence or safety or protection. And so, in extreme, you can argue that cryptocurrencies are a protection against the meltdown of the monetary system. And 10 years ago, the meltdown of monetary system would have had a zero probability of occurrence. Today, it's not very high, but it's not zero. So does it provide you with some store of value? Yes, it does. But it's usually better to have a store of value that actually have some kind of a pedigree and some kind of usage in the system. Not necessarily income, but at least usage. And that's where gold comes in. So if you look at the relationship between cryptocurrencies and inflation or interest rates, it's not very good. Cryptocurrencies has the best correlation to equities rather than anything else. But gold actually does have a relationship to both inflation and interest rates, and much less so to equity markets. So what it tells you essentially, if you're worried about inflation, if you're worried about getting out of control, gold provides you with a safety mechanism. So to me, neither gold nor cryptocurrencies are really investable assets as such, but they do provide insurance for your portfolio against extreme outcomes that potentially could occur. And in that respect, either in terms of volatility. Remember, cryptocurrencies have 10, 20 times more volatility than gold or the currencies themselves. Either in terms of volatility or in terms of usage, I feel if your concern are the inflationary outcomes, then gold provides a better hedge than cryptos. Now, also you need to separate. Everybody calls everything cryptocurrencies, but a lot of them actually not aiming to be currencies. There is no question that blockchain, together with artificial intelligence, are the two biggest themes over the next 10 to 15 years. And you can put robotics automation under artificial intelligence because that's where it's going to belong. So that's your biggest themes going forward. And blockchain will and are revolutionizing everything. For example, the banking sector clearly is not going to look anything like what it does today in 5 or 6 years' time. So it's revolutionizing money market, capital market, registry systems. So one has to be a little bit careful because everything is lumped together as a cryptocurrencies, even though the underlying technology is actually used for many users that are going to be incredibly important as we go forward.
Could you expand on that, Victor? Why you say that it is going to be this blockchain that is going to be, well, the word is DeFi, of course. I assume it's just the taking of these organizations and then just creating a common ledger.
Yes, yes, it's a much easier, much quicker, much lower transaction cost. You don't need to have correspondent banks, for example, to transact. You can bank effectively areas that are unbanked right now in many forms. It also would lead you to central bank digital currencies. And central bank digital currencies will perform many functions, including wholesale tokens, retail tokens, deposits, lending functions. And so if you're a bank today, you have a couple of problems. Problem number one is that you're living in a world where we have excess capital. As we said, we have 5, 10 times more capital than we need, essentially. So banks are not very good when there is too much capital around. Number two, capital increasingly allocated by the government for social purposes rather than private sector oriented purposes. Again, banks are not really structured for that. Three, technology, whether it's blockchain or more conventional technology and AI technology, enables fintech companies to accumulate deposits as well as judge and assess risk as good as the commercial banks can do, in fact, better than commercial banks can do it. And then you have a problem of central banks interference. Central banks increasingly determining cost of money and the volume of money. So in other words, if central banks fix the price and they don't like what private sector provides them, they just create liquidity. Or they create liquidity, and if they don't like the price that private sector gives them, they fix the price. And so if central banks fix the price and volume, why do we need prime dealers for? And the answer, we probably don't need them. And then, of course, central bank digital coin coming in China at the end of 21, early 22, and then through 22, 23, that would apply to most other areas, will give another tool for central banks that can be used to, as I said, wholesale token, retail token, lending, deposit taking, everything. Now, central banks will tell you they don't want to disintermediate the banks. They don't want a loss of deposits out of the banking system. But experience tell you if central banks have a tool, they will use it. The next pandemic, the next disaster, they're going to use it. And so the question is, if banks increasingly will become not as relevant in multiplying money, if they're not as relevant in determining the price of money, if they're not as relevant in garnering deposits or assessing credit risks, then what are they there for? And the answer is not clear to me. What exactly they're going to do. I'm sure there will be functions. I'm sure there will be pockets. I'm sure there will be packaging. I'm sure they're going to do things. But one thing is clear to me, franchise value of the banks will be completely determined by central banks. In other words, not determined by the market. It's central banks that will determine what the banks are worth, what their spreads will be, and where they're going to function. And prior to coronavirus and prior to expansion of digital technology the way we had over the last sort of 18 months, You would have said all of that maybe 10 years away. Now you would argue, no, probably as little as five. It could actually occur a lot more rapidly.
Viktor, thank you for speaking with Kitco.
Thank you very much, Michael.
He is Viktor Shvets. He is global strategist at Macquarie Bank and author of Great Rupture. My name is Michael McRae, and you are watching Kitco News.